Jim, welcome back. It's good to see you again. So we're just going to have a bit of a little chat about Kootenay silver and, kind of questions that we get all the time. And one would be, what's the leverage? I get this all the time. What's the leverage that your company has, Kootenay Silver has, to the silver price?
Yeah, well, thanks, David. A little bit choppy connection here today. So if I start to answer a question that I haven't answered, doesn't quite match the question, that's why. But we're a silver exploration company, and we have tremendous leverage to the silver price. We've got two resources defined so far. We have a third discovery that we're doing a resource on this year. So by hopefully mid-year, we'll have three different deposits with resources on them. And so we've got a large resource base already. We're making new discoveries, two properties that maybe will result in new resource discoveries this year. And when you look at our chart, we correlate very, very well with the silver price.
Very good. And before we move on, Jim, for let's say some of the people that are newer to the industry, can you define resource in layman's terms, because it's different than?
Okay, so in exploration, you're out there trying to discover something brand new that hasn't been found before. And so the range goes from a prospect, which is you kick a rock over and you break it and you see some mineral in it. That's a prospect. Then you get up to a drill discovery where you go in and you drill that prospect and you hit in the drill. And maybe you hit in half a dozen drills. But when you get to the stage where you have tens or even hundreds of drill holes into a resource where you show there's continuity and there's size and to the continuity, then you do a calculation and an estimate, and that's a resource. So a resource gives you, it's a study and a whole lot of drilling and work that goes in it that gives you confidence as to exactly how many ounces of silver do you have there, how many tons, and what's the grade, which are important factors in helping determine economic viability of the resource.
Thank you. I don't want to take much of your time, but people, listen, that's very important. There's a whole big difference about someone that has a resource than someone that's out there kicking rocks. And you don't always get that from, let's say, how the stock might be promoted. So back to you, Jim. What's going to drive the company's stock price this year, you think?
Well, two things will drive the stock price. As I mentioned, we correlate so well with the silver price. That certainly drives it. And silver has been making a great base here. The chart currently looks really bullish to us for a breakout strongly above $30 at some point in time, and we hope the near future. And then the other drivers are the work we're doing on the ground. So we're drilling the high-grade Columba project in Mexico and also the Copalito. Columba is got quite a few holes into it now. It looks like we've got real good continuity in one of the veins, really good grade. So continued success there in the drilling and start to establish continuity in size that looks like it could be economic will drive the price. Similarly, Copalito, similar results would drive the price there. Then two of our resource bodies we're advancing this year as well, and we're doing work there to improve, in one case, the economic viability. We think the grade's going to end up being better. And then on the other resource, it's the first time ever estimate will be done on it. And so those two, if they work out, will maybe start to get fast-tracked on good results towards a preliminary economic assessment. And of course, that is a very positive development. And any one of those, or a combination, or all of them, if we're really lucky, will help drive our price.
Great. So you can't do anything without money. We all know that, or I'll say currency. Keep Mike Maloney happy. But where are you financially right now in the country?
Yeah, we're in good shape. We're really well financed for this year's program. We are at about 10 million Canadian, or maybe just under right now, and this being near the end of February. And so we're fully financed for the programs we have laid out on the 4 primary projects that we're advancing this year.
Great. I'll put the heat on you that I get all the time. What's your outlook going forward?
Well, our outlook in the big macro picture is very bullish on the precious metals, very bullish on silver. And these last few days have been interesting watching the trade between gold and silver, because gold, as it's showing some softness here currently, silver is not. Silver's being very resilient and heading in the, looks like it's heading in the other direction, that being up, whereas gold is kind of drifting downward temporarily in our view. So what we see is, looks like to us like silver's finally going to really break to the upside and start to close that famous gold silver ratio and start driving it back down toward the median. And then of course it'll go much the other way. And when that happens, the increase in silver price is much greater, relatively speaking, than that in gold. And so you get this great leverage in silver in this part of the market.
Well said. I'll just add a bit to it. You said it very succinctly, but you know, it went from this high that's like twice in all recorded history, or like 120, 125 to 1. We got down to 80 to 1. I'm very conservative. I said I really wouldn't be happy till we see below 70 to 1. Right now we're at 65 to 1 as we're doing the interview. So certainly I do believe silver will do what it's supposed to do in the final phase of a huge bull market, and that is well outperform gold. And where's it going to go? Nobody knows, but it could go from the 65 to 1 to 33 to 1, which would be double the performance of gold from here. And that was what we hit already in this bull market. I think it'll overshoot. I think it could go half again. It could go 16 to 1. I don't know. I'm not predicting that. So we got about a minute left. I just want to circle back and have you talk about a PEA, a preliminary economic assessment, because you don't get that far unless you've really, really done a lot of work, a lot of drilling, and really know what's going on. So can you just add on to that for our viewers what PEA means?
Okay, so it has to start with the resource estimate, and you take a look at your resource estimate and you do some back of the envelope work to tell yourself, well, does this look like it's close at these silver prices to being able to be viable economically? In other words, build a mine. And then if you have enough data, you can advance to a preliminary economic assessment. So first of all, you need a lot of drill holes in that to establish that resource. Secondly, you need to do a fair, well, I won't say extensive at PEA stage, but you need to do a reasonable amount of metallurgy, and that tells you how much of the metal, in our case, silver, can you extract economically speaking. And so if you've got, let's say, 400 gram per ton silver and you can extract 90% of it, well, you're getting out 360 grams, and that's what you can sell. So that obviously goes right to the bottom line, your economic assessment. So you combine those two things together and you start to plug them into your economic assessment. And the other things you look at is what kind of deposit do you have? Is this open pit? What's the strip ratio? How many tons of waste do you have to move to get 1 ton of ore? If it's 4 to 1, well, you're moving 5 tons of rock for every 1 ton of ore. So that's an additional cost. And that's in our $2 range in the case of open pit. Now, if you're underground, it's a different situation. It's higher cost, but you're not moving a lot of waste rock. You're getting right in your ore. So it's a little bit different. So you have to know what kind of deposit it is, whether it can be underground or open pit or a combination, and what the recovery is. And all these cost factors go into a preliminary economic assessment, and they come out the other end saying, all right, it's going to cost you X to build this thing. You're going to produce these many ounces. It's going to cost you this much per ounce to produce, and here's your profit. At the end of the day, here's how much it costs to build, and here's what's left over. And that goes into your IRR calculations and net present value and everything else. So it's a first step. It's pretty rigorous, and then the next steps are pre-feas and feasibility that start to answer some of the questions that maybe don't get answered in a PEA.
Right.
But once you get to a positive PEA, the market really starts to pay attention in a different way, in a more serious manner. You attract different investors. You really start to attract the mining companies, and puts you in a different realm.
Right. And for everybody, we're out of time, but it's really hinges on people. And Jim won't boast, but he's done it, been there. He's got quite a track record. Jim, it's always great to spend time with you. Thank you so much.
Thank you, David, and a pleasure being on again.